Welcome to Talk Tickers.
Glad to be here for this one.
Yeah, we've got a really critical deep dive today. We are stripping all the usual sentiment out of a topic that, usually just gets buried in political rhetoric or kitchen table anxiety.
Right.
We are going to mark to market an asset class that is likely the largest fixed income position in your personal portfolio, even if you don't actually market to market on your balance sheet every single month. We are talking about the Social Security retirement benefit.
Exactly. And I want to be really clear right off the top here. We are not approaching this from a social welfare perspective.
No.
We are approaching this as institutional investors. We're analyzing a very specific financial instrument. If you actually look at the underlying structure of Social Security, what you hold is a government-guaranteed, inflation-indexed, tax-advantaged annuity.
Right. And if you tried to replicate that instrument in the open market, say you went to a commercial insurer, right?
Yeah.
Like Mass Mutual or New York Life.
Good luck.
Right, exactly. If you ask them for a product that pays you for life, adjusts for the consumer price index every single year, and carries the full faith and backing of the U.S. Treasury, the premium you would have to pay for that would be astronomical.
It would be unpriceable in today's market. You can't find that kind of duration risk coverage with an inflation float.
But despite that, most investors, even really sophisticated ones, they treat the claiming decision as this completely passive event. They turn 62 or 65 and they just hit the sell button without ever modeling the valuation.
Which is just a massive error in trade execution. I mean, the thesis we are exploring in this deep dive is that Social Security is an active portfolio management decision, period.
100%.
It offers a very specific type of alpha, and we'll get into the math, but specifically the 8% annual roll-up for delaying the claim. That is virtually impossible to replicate elsewhere in the current yield environment without taking on massive equity risk.
So our mission today is to essentially deconstruct the valuation model. How is the benefit actually calculated? What is the trade execution strategy to maximize your yield? And what are the headwinds, the taxes, the earnings tests that can blow up your returns?
Let's start with the asset structure itself, because words matter. When we talk about longevity risk in a portfolio, what are we actually hedging against here?
Right. Well, we're hedging against the risk of efficient healthcare, really.
Exactly.
The risk is simply that you live too long. In financial planning terms, longevity risk is just the probability that your lifespan exceeds the duration of your asset base.
Yeah, you outlive your money.
You outlive your money. And Social Security is essentially a single premium immediate annuity, a SPIA.
A mandatory one, basically.
Right. You pay your premiums in the form of FICA taxes during all your working years, and in exchange for that capital outlay, you get a monthly cash flow for life.
But unlike a standard corporate bond ladder or a normal commercial fixed annuity, this cash flow has a built-in KLA, a cost of living adjustment.
And we really need to pause on that COA because that is the critical differentiator for this asset class. Most fixed income out there is strictly nominal.
Right.
If you buy a corporate bond yielding 4% and inflation suddenly spikes to 5%, your real return is negative. You're losing purchasing power. But Social Security is one of the very few retail assets that floats directly with the CPIW.
Correct. And that inflation protection applies to the entire benefit structure, which compounds beautifully over time. But this brings us directly to the valuation inputs.
The pricing model.
Exactly. If we were valuing a blue chip stock, we'd look at earnings, operating margins, PE multiples. For Social Security, the price of the asset, your monthly payout, is determined by three main variables.
Okay, lay them out.
First, you have the A and E, that's the average indexed monthly earnings. Second is the PIA, the primary insurance amount. And third is your claiming age.
And that claiming age acts as a leverage multiplier.
Or a discount factor, depending entirely on when you execute the trade.
All right, let's drill down into the engine room first. Variable number one, the NNE, the earnings history. How exactly does the administration calculate this? Because it's definitely not just your last 5 years of salary, right?
No, not at all. And that's a really common misconception, mostly drawn from the old defined benefit pension world. Corporate pensions or state pensions, they often look at your high 3 or high 5 years of compensation to set your payout.
Right, the golden years at the end of the career.
Yeah, but Social Security looks at your highest 35 years of indexed earnings. The number 35 is hard-coded into the algorithm. It is not negotiable.
So if you're listening to this and you've only been in the workforce for, say, 30 years, maybe you took time off to raise kids, or you started your career late after grad school, what happened?
That introduces what we call the zero drag.
The zero drag.
The zero drag. The formula strictly requires 35 data points. If you only have 30 years of paid-in earnings, the administration just enters a zero for those missing 5 years. Yeah. When you average 5 literal zeros into a 35-year data set, it significantly dilutes the mathematical average. It pulls down that A, which directly pulls down your permanent monthly payout.
That's a huge penalty for a gap on the resume. But wait, they don't just take the raw nominal dollar amount you earned back in 1990, do they? Because 30 grand in 1990 bought a whole lot more house than it does today.
You're exactly right. And this is where the system is actually quite fair. This is the wage indexing mechanism.
How does that work?
It's basically a retrospective inflation adjustment. The Social Security Administration takes your historical earnings year by year, and they index them to the National Average Wage Growth Index up to the year you turn 60.
Okay, so that $30,000 entry-level salary from the mid-'80s gets stepped up.
Adjusted upward to reflect what that standard of living would cost in today's nominal dollars, yes.
But you said up to age 60. That's a really specific cutoff.
It is. The indexing strictly stops at age 60. Any earnings you make at age 61, 62, and beyond those are taken at absolute face value, nominal value.
They aren't indexed at all.
No. But for the vast majority of your career, your basis in the system is actively being stepped up to account for overall wage inflation. This whole calculation, running those 35 highest indexed years, produces the AIM, the monthly average.
Okay, so we have the raw input now. We have the AIM. Now we have to convert that raw monthly average into the actual benefit check, which is the PIA.
The primary insurance amount.
Right. And this isn't a flat percentage. It's not like they just say, okay, you get 40% of your AIM across the board.
No. It operates much like a progressive tax bracket, but completely in reverse. We call the thresholds the bend points.
Bend points. Walk us through those, because this is where the ROI really shifts depending on your income level.
The formula is structurally designed to give a much higher replacement rate to lower earners and a lower replacement rate to higher earners. For 2026, the bend points create 3 specific tranches of returns.
Okay, what's tranche 1? Where is the yield highest?
The first tranche is incredibly valuable. On first $1,286 of your AIM, the system replaces 90% of it.
90%.
90 cents on the dollar. That is a massive guaranteed return on investment.
That's essentially the social welfare component baked right into the floor of the asset.
Precisely. They are guaranteeing that even the lowest lifetime earners get a functional baseline. But then we hit the second tranche. For average earnings between that $1,286 and $7,749 per month, the replacement rate drops to 32%.
32%.
Okay.
So still a decent yield, but a really significant step down from 90.
A huge step down. And then we hit tranche 3. For any average monthly earnings above that $7,749 mark, the replacement rate collapses down to 15%.
15%. So for the high net worth individuals listening to us right now, the people who are maxing out the Social Security payroll tax base every single year of their careers, they're pushing really deep into that 15% tranche.
Correct. They are seeing severe diminishing marginal returns on their top end contributions.
Right.
However, I will caveat that. Even at a 15% replacement rate, when you couple it with the lifetime COLA and the pure longevity protection, it is still not a bad asset. But the leverage on those final dollars is certainly much lower than it is for a median earner.
Sure.
Anyway, you run your AIM through those 3 tranches, add up the results, and that gives you your primary insurance amount, the PIA.
And in bond terms, the PIA is the par value of the asset.
Yes, the par value.
It's exactly what you get if you claim at full retirement age. Which brings us perfectly to the execution strategy, the trade itself.
This is where the alpha is made or lost.
Right. We have our par value, but we have the option to take a discount on it or wait and hold for a premium. First, let's establish the baseline. Let's define full retirement age, or FRA, because those goalposts have definitely moved over the last couple of decades.
They have. For anyone born in 1960 or later, which covers the vast majority of the active workforce modeling this out today, your FRA is 67.
67 is the new standard.
That is the baseline. That is the exact age where you are entitled to 100% of the PIA we just calculated.
But the trading window opens earlier. It opens at 62.
It does.
Let's call claiming at 62 the short position. You are essentially shorting your own longevity.
Yeah.
You want the cash right now. What is the actual cost of executing that trade?
It's a steep haircut. If your FRA is 67 and you execute the claim at 62, your monthly benefit is permanently reduced by 30%.
30% permanent loss of par.
You are locking in 70 cents on the dollar for the rest of your life. Now, the logic for taking this trade is almost always liquidity.
Sure, cash flow constraints.
If you have a cash flow crisis, or perhaps your health is severely compromised and you genuinely don't expect to live past age 75, claiming early lets you capture some tangible value before you exit the system entirely.
But if you are in good health and you have adequate portfolio assets and you claim at 62 simply because of that emotional bias, the whole "it's my money and I want it now" mentality, you are voluntarily locking in an impaired asset for potentially 30 or 35 years.
Exactly. You are permanently capping your inflation-adjusted floor, and every future COL will be applied to that smaller base, which is exactly why we need to talk about the long position.
Delaying past FRA.
Yes. This is the ultimate alpha generator in retirement planning.
This is the 8% number you hear thrown around. Walk us through the pure mechanics of this roll-up.
Once you pass your full retirement age of 67, every single month you delay claiming. You earn what the SSA calls delayed retirement credits, DRCs. The statutory rate is 2/3 of 1% per month. If you annualize that, it sums up to a simple interest rate of exactly 8% per year.
Just pause on that for a second. In a macroeconomic world where a 10-year treasury is yielding maybe 4% and a high-yield savings account is maybe paying 3 or 4, a guaranteed 8% roll-up is extraordinary.
It's unmatched. It is risk-free, federally guaranteed alpha. Period. If you delay from your FRA of 67 all the way to 70, which is the maximum age, you accumulate 3 full years of those 8% credits.
So 3 times 8.
That is a 24% absolute increase on top of your PIA par value. Let's put dollars to it. If your base benefit at 67 was $3,000 a month, waiting until 70 automatically bumps that baseline to $3,720.
And here's the kicker, right? That 24% bump, that extra $720, is also fully inflation protected going forward.
That is the compounding magic of the system. The annual CLA applies to the entire benefit, including all those delayed retirement credits. So that extra 24% gets adjusted for inflation every single year for the rest of your life.
Yeah.
The spread between claiming at 62 and claiming at 70 isn't just a static gap. It literally widens in absolute dollar terms every single year because of that CLA compounding.
Now, there's a slight operational nuance here regarding the DRCs that I want to make sure you address. The delayed January bump. I know this is in the weeds, but institutional traders care about settlement dates.
Yes, the settlement lag. This is a back office detail that constantly catches people off guard. Delayed retirement credits are technically credited on a January to January cycle by the SSA computers.
What does that mean in practice?
Say you decide to finally claim your benefit in July, and you're 68 years old. You have accrued delayed credits from January through June of that current year. However, your monthly checks for the remainder of that calendar year might not actually reflect those specific 6 months of new credits immediately.
So you're getting shortchanged.
Temporarily, yes. The administration runs a true-up the following January. They calculate the missing credits, apply them, and your check jumps up. You get the money, but there is a distinct cash flow lag. It's an underpayment that resolves itself automatically, but you have to know it's coming so you don't panic.
Good to know. So we delay to 70. Let's talk about the ceiling. Is there any financial reason whatsoever to delay claiming past age 70?
None. Zero. The delayed credits completely stop accumulating the very month you turn 70. It is a hard statutory cap. If you haven't claimed by 70, you are essentially just donating your monthly cash flow back to the U.S. Treasury. Execute the trade immediately on your 70th birthday.
Okay, so the classic counter-argument we always hear to delaying, the objection from retail investors, is the break-even analysis. The idea that, hey, if I delay to 70, but then I die at 68, I completely missed out on 6 years of checks I could have been cashing starting at 62.
Yeah.
When does the actual crossover happen?
If you run the pure math comparing the cumulative cash flow of claiming early at 62 versus delaying to 70, the break-even point typically lands somewhere between age 80 and 82.
Okay.
Specifically, if we model claiming at your FRA of 67 versus delaying to 70, the cumulative cash flow crossover is generally right around 82 years and 7 months.
So the fundamental bet is, will I live past 82 and a half?
That is exactly how most retail investors frame it, but I would argue that is entirely the wrong risk framework.
Why?
We are anchoring on averages. But as an individual, you don't experience average mortality. You experience binary mortality. You either die early or you live long. Actuarially speaking, 1 out of every 3 65-year-olds alive today will live to age 90.
1 in 3.
Yes. If you happen to fall into that top turtle of longevity, the cumulative financial loss from claiming early can easily run into the hundreds of thousands of dollars.
So you're saying we should view delaying not as a gamble on living a long time, but as explicit insurance against outliving our other portfolio assets.
Precisely. Think of it this way. If you delay and you die at 74, yes, you mathematically lost the bet on maximizing Social Security, but you likely died with your other IRA or brokerage assets completely intact because you didn't have enough time to spend them down.
But you didn't actually need the longevity insurance to pay out.
Exactly. But if you live to 98, that is the exact scenario where your personal portfolio is under the most extreme stress. That is when you desperately need the maximum inflation-adjusted annuity ticking in every month. Delaying the claim is a direct hedge against the tail risk of a very long life.
That makes perfect sense. All right, let's pivot to the derivative strategies. Everything we've covered so far focuses on the primary worker, but for married couples listening, this is a joint portfolio management problem.
Absolutely.
Talk to us about the spousal benefit top-up.
The spousal benefit essentially creates a guaranteed floor for a lower earning spouse. The basic rule is that a spouse can claim up to 50% of the higher earner's primary insurance amount, the PIA.
But note she said PIA.
Yes, and that's crucial. Spousal benefits are strictly based on the par value at the FRA of 67. They are not based on the delayed value at 70.
Okay, so if I'm the high earner and I delay to 70 to get that 24% bump, that doesn't boost my wife's spousal benefit while I'm alive?
No, it does not. The spousal benefit maxes out the moment the primary earner reaches full retirement age. Delaying further does nothing for the spousal piece while you are both living. And importantly, you cannot double dip the system.
Explain that.
The SSA will always automatically pay your own worker benefit first based on your own earnings record. If your own earned benefit happens to be lower than 50% of your spouse's PIA, the SSA simply adds a top-up to bridge the gap and get you exactly to that 50% level. You don't get both checks stacked on top of each other.
Got it. But the real strategic derivative play here, the one that really moves the needle, involves the survivor benefit. This is where that 8% annual roll-up we discussed earlier gets a massive step up in basis, effectively.
This is the joint life play. And frankly, it is the single most important takeaway for married couples modeling this asset. When one spouse dies, the surviving spouse keeps the higher of the two checks that were coming into the household.
The lower check just disappears.
It vanishes. The household income drops, but the survivor retains the maximum possible single cash flow.
Okay, so let's run a scenario. If I am the high earner in the household, I delay my claim until age 70 to get that fully maxed out $3,720 benefit, but then I have a heart attack and die at age 72. What happens to my spouse?
Your spouse essentially inherits that exact $3,720 monthly payment for the rest of their natural life.
Including the delayed credits I earned.
Yes, the survivor benefit captures the entire delayed value. Now contrast that. If you had claimed early at 62, locking in a severely reduced benefit of, say, $2,100, your surviving spouse would be permanently stuck with that $2,100 survivor benefit. Assuming it's higher than their own, of course.
That completely shifts the break-even calculus we talked about earlier. I am no longer just betting on my own individual life expectancy. I am betting on the second-to-die life expectancy of the household.
Exactly right. If either you or your spouse has a high probability of living past age 85, maximizing the primary earner's benefit by delaying to 70 is mathematically the superior trade.
It's acting like a reversionary annuity.
Yes. The higher earner essentially has a fiduciary duty to the household balance sheet to strongly consider delaying, because by delaying, they are actively purchasing maximum survivor protection for the lower earning spouse.
Makes total sense. And just a quick note on the legal side here, because it comes up, divorce. Does an ex-spouse have a claim on any of these derivative benefits?
They do, provided the marriage lasted for at least 10 consecutive years and the applicant claiming the benefit hasn't remarried. They can claim both spousal and survivor benefits based purely on the ex-spouse's earnings record.
Does that dilute the pool for the primary earner?
Crucially, no. It has absolutely zero financial impact on the primary earner's payout, nor does it affect the payout to their current spouse if they remarried. It is treated as a completely separate liability on the Social Security Administration's balance sheet, not yours.
That's a great feature. All right, let's move into the risk factors, the poisons that can degrade the value of this asset class. Because institutional investors hate hidden fees and clawbacks, and Social Security definitely has a few buried in the fine print.
Oh, absolutely.
The first one is WEP, the windfall elimination provision. Who is the target for this clawback?
The primary targets are public sector employees. We're talking teachers in certain states, police officers, firefighters, some older federal employees. Basically, anyone who earned what the SSA calls a non-covered pension.
Non-covered meaning what?
Meaning they worked in a government job where they did not pay FICA Social Security taxes into the system. But they also have some separate work history in the private sector where they did pay into Social Security for enough quarters to qualify for a benefit.
Okay, so the computer system sees them claiming a public pension, plus asking for a Social Security check. And it flags them as double dipping on that progressive formula we discussed earlier.
Exactly. Remember that really generous 90% replacement rate on the first tranche of earnings.
Tranche 1.
That is mathematically designed to help low-income workers stay above the poverty line. But a career civil servant who retires with an $80,000 annual government pension looks exactly like a low-income worker to the Social Security computer because it only sees their limited part-time or early career private sector earnings.
Okay.
So the WP mechanism steps in to aggressively correct this. It slashes that 90% factor in the first tranche. Depending on your years of private sector work, it can drop that replacement rate all the way down to 40%.
That is a massive reduction in the base par value of the benefit. Is there a cap on how much pain the WEP can inflict?
There is a guarantee rule in place to prevent total wipeout. The WEP deduction cannot legally exceed 50% of your non-covered pension amount. So they can't take more than half the value of your teacher's pension away from your Social Security check.
Still, for a lot of people modeling their retirement cash flow, that WEP penalty completely wipes out a significant chunk of their expected fixed income.
It's a huge shock if you aren't modeling for it.
Okay, the second constraint or poison we need to cover is the earnings test. This applies to people who try to execute the short trade claiming early, say it's 63, but they keep working their W-2 job. A lot of retail investors feel like this is a 50% tax on their income.
It certainly feels highly punitive, but technically, structurally, it is a forced deferral, not a tax. Here's how it works. If you claim early, meaning you are under your full retirement age, there is a strict limit on how much you can earn from active wages. For 2026, that limit is roughly $24,480.
Okay, and if I earn more than that?
For every $2 you earn above that specific threshold, the SSA aggressively withholds $1 of your Social Security benefits.
So if I'm 63, I claimed early, but I'm still pulling down $100,000 a year in salary, the SSA basically just halts my benefit checks completely.
Correct. They will withhold the checks until the math balances out. But, and this is the critical part that almost everyone misses, that withheld money isn't actually confiscated forever.
It's not.
No. When you finally hit your full retirement age of 67, the SSA automatically runs a recalculation. It's called the Adjustment of the Reduction Factor, or ARF. They basically look at your record and say, okay, we withheld your checks for 12 months because of your earnings. So we are now going to treat you actuarially as if you had claimed 12 months later than you actually did.
Oh, so they adjust your claiming age.
Yes. Your permanent monthly check gets adjusted upward at FRA to account for those withheld months. You eventually get the actuarial value of that money back over your lifetime.
You get the value back, sure.
Yeah.
But you completely lost the liquidity when you supposedly wanted it.
Exactly, which raises the fundamental portfolio question. If you are still working and you are earning enough to trigger this severe withholding test, why are you executing the early claim in the first place? You are just creating a massive administrative headache and unfavorable tax dynamics for absolutely zero net gain in current cash flow. Usually, if you are still working, the mathematically optimal trade is to just delay filing entirely.
Speaking of unfavorable tax dynamics, let's discuss the actual taxation of these benefits. There's this lingering myth out there that Social Security is tax-free income. For the Talk Tickers audience listening right now, that is almost certainly false.
It is absolutely false for anyone with a reasonable portfolio balance. We have to deal with a metric called provisional income here.
Walk us through the formula for provisional income.
The IRS formula is your adjusted gross income, or AGI, plus your non-taxable interest, plus exactly 50% of your annual Social Security benefit. Add those three up, and that's your provisional income.
Stop right there. Non-taxable interest, you mean municipal bonds?
Yes. This is what we call the muni trap. Sophisticated investors load up on municipal bonds specifically for the tax-free income generation, but the IRS explicitly requires you to add that tax-free interest back into the formula when calculating whether your Social Security benefits cross the threshold into being taxable.
So you cannot hide your yield in munis to avoid the tax on your Social Security.
You cannot. It is a very tight net.
What are the actual income thresholds where the taxation kicks in?
They are shockingly low, because they were established by Congress decades ago, and crucially, they were never indexed for inflation.
Bracket creep.
Classic bracket creep by design. If your provisional income is over $34,000 for a single filer, or just $44,000 for a married couple filing jointly, up to 85% of your Social Security benefit suddenly becomes taxable at your ordinary income rate.
$44,000 for a married couple.
Yeah.
If you are drawing from an IRA, you're going to blast right through that threshold instantly.
Instantly. Almost every mass affluent investor will pay taxes on 85% of their benefit.
And this creates what financial planners call the tax torpedo. Explain the marginal rate impact of this torpedo.
This is where the math gets really ugly. Because of how the provisional income formula phases in, every additional dollar you withdraw from a traditional IRA doesn't just add a dollar to your taxable income. It can trigger taxation on an additional 85 cents of your Social Security benefit that was previously sitting tax-free.
So pulling $1 out of my IRA actually adds $1.85 to my taxable income line.
Exactly. You aren't just paying your stated bracket rate on the IRA withdrawal. You are effectively paying tax on $1.85 of income for every dollar you pull. This can push your effective marginal tax rate drastically higher than your statutory bracket, sometimes pushing well over 40 or 50% for that highly specific slice of income.
So actively managing your provisional income, perhaps executing strategic Roth conversions before you actually claim Social Security, that becomes a strictly critical part of the overall portfolio strategy.
Absolutely essential. Keeping your AGI mechanically low in retirement allows you to preserve the tax advantage status of the Social Security asset. It's a key lever in maximizing the net yield.
All right, we have covered the core valuation inputs. We've mapped out the trade execution from early claiming to delayed credits. We've explored the derivative strategies for spouses, and we've navigated the risks from WEP to the tax torpedo. Now, as we wrap up, it is time for the signature segment, the one question.
Let's do it.
If the investors listening right now are sitting down with their wealth manager, or they were just firing up their own Excel models, what is the single most important question they need to ask to cut through all the noise on this topic?
The one question you have to ask is, what is the survivor break-even age for my household, not just my individual break-even?
And why does that distinction matter so much?
Because most investors satisfy themselves with a purely personal and frankly selfish calculation. They look at a chart and say, well, I probably won't live to 82, so I'm just going to hit the bid and claim early at 62. But the correct institutional calculation for a married household is determining when the second person will pass away. If the higher earner executes an early claim, they are permanently impairing the survivor's annuity for decades. If either spouse has a reasonable probability of making it to age 90, the long position delaying to age 70 is mathematically the undeniable winning trade to protect the household balance sheet.
That is a remarkably powerful perspective. Let's recap the core takeaways from today's deep dive. Number one, valuation. Your asset's par value is a strict function of your highest 35 years of wage-indexed earnings. Avoid the zero drag at all costs.
Absolutely.
Number two, timing the trade. Delaying your claim past your full retirement age isn't just passive waiting. It is actively purchasing an annuity with a guaranteed 8% roll-up plus full inflation protection.
Unmatched alpha.
Unmatched. And number three, taxation. You have to watch your provisional income carefully. Municipal bonds will not hide your yield here, and the tax thresholds are not indexed for inflation, making the tax torpedo a real threat to your net cash flow.
Spot on. And my final thought for everyone modeling this is simply this. Treat Social Security as the bedrock fixed income floor of your entire asset allocation. Because you have this government-backed, inflation-adjusted safety net perfectly covering your basic household burn rate, it actually frees you up to take significantly more calculated risk with your liquid equity portfolio. Optimize this asset for extreme longevity, not for instant gratification.
Here is a final provocative thought for you to mull over. We always hear panic about the Social Security Trust Fund depleting in the 2030s and the threat of an across-the-board 20% cut to benefits if Congress does nothing. Most people use that fear to justify claiming early, take the money and run. But if you actually run the math, a permanent 20% haircut makes delaying to age 70 even more critical. Because if your benefit is getting slashed, you desperately need to maximize the underlying base par value with those 8% roll-ups just to maintain your purchasing power. The cut actually increases the value of the delay.
That's a great point to model out.
That is it for this deep dive. Do not leave guaranteed alpha on the table just because the ticker symbol belongs to the Social Security Administration instead of the New York Stock Exchange. Trade smart.